Before we get to what happened overall in the week, what about there right at the end on Friday with the Moody's downgrade of U.S. credit? How material is that?
So, material, if we're talking about does it have an important impact on people's desire or ability to hold US debt, it's not going to be so important. But as a signal of how dysfunctional the US policy making is right now, it's very important, I'd say. I mean, it's a reminder that we are looking at an extremely serious fiscal problem between the debt and the deficit. And the way we are operating right now is not very reasonable. So it's a good reminder that fiscal policy is an issue, and markets should pay potentially more attention than they are to fiscal issues.
And it comes against the backdrop of a fair amount of volatility in your neck of the woods, that is fixed income. We saw again this week the ups and downs. They may not have been quite as big, the amplitude may be a little less than it has been, but it's still a fair amount of volatility because I'm not sure the markets know where it's going.
I think that actually, if you look at what's happening with markets, what we saw last week really was once again, we've been to this show, David, right? We've done this before many times over the last year and a half. You have a Fed meeting, the market hears what it wants to hear from what the Fed is saying, and runs with it. So what I think that Jay Powell was trying to do, not this week, but the week before, was to give the market a gentle nudge in the direction of a slightly more dovish message. The market took that slightly dovish message and simply ran with it. We had a close to 40 basis points rally in the 10-year on the back of the Fed, on the back of slightly different than anticipated schedule from Treasury in terms of issuance, and a slightly softer job market report. The three of them together do not change enough of what's happening on the ground to justify the type of rally we saw. And indeed, this week we've seen a bit of a sell-off, that roller coaster you were talking about. I think the market's still really, really focused on trying to figure out whether the Fed or the Treasury can swoop in and make it all okay again so that rates can rally and we can go back to the races.
Given that situation, Sonal, what's an investor to do? How do you try to protect yourself and actually make some money in this environment right now? Cash is actually worth something now, or near cash is worth something. But what do you do with your bond portfolio? Let's talk about that specifically.
So actually, you're right. Cash has been very good for people this year. You're getting a very good return on cash. However, as we get towards the end of this year, I said that I've been saying for a while that the Fed is likely to maintain higher rates for somewhat longer than the market is anticipating. We're not getting ready. We are certainly not forecasting 100 basis points of rate cuts starting already from the middle of next year, as is being now priced by the market. Nonetheless, as we get towards the next several months, I think the time to start moving away from that very, very short duration and cash and fixed income, it's coming. Because we are looking, once you get 10 years at round 5, once you look at high quality investment grade credits and mortgages, areas like this are yielding over 6%. These are actually pretty attractive yields to start slowly averaging into a little bit of duration, is how I would put it. I don't think we chase the yield because the type of volatility we've seen, it's not gone away. I do think we're going to probably see 5 again. So there's time to start factoring that in, but averaging in a true fixed income portfolio where you start adding a little bit of duration, it's a good idea to do right now, around now, over the next 3 months, over the next 6 months. And I'm looking forward to fixed income actually playing that traditional role of delivering income rather than equity-like returns. Looking at next year, I'm not looking for massive capital gains out of fixed income.
What about
outside the United States?
Sorry, what about outside the United States, Europe, Japan?
So that's a really interesting point. So in Europe, we actually think that the underlying growth fundamentals make duration plays in Europe potentially more attractive even than the US. So that's one area because growth in the euro area is simply not as well supported as it continues to be in the US. We're slowing in the US, but we're starting from a very good place. Japan to me is the really fascinating one because Japan and Japanese investors have actually been a major source of support for the long end of the US yield curve because rates have been so low, and Japan within the G3, the BOJ is very much behind the Fed and the ECB in terms of changing its monetary policy stance. So I think that over the next 3 months, next quarter, 3, 4 months, we are going to start seeing a change in policy in Japan. And that potentially is going to start making the yen look quite attractive. The yen has sold off. It's at close to record lows right now. We're at around 152 yen to a dollar. Great time to go visit Japan. It's cheap for once. But having said that, I'd say that looking forward into the next 3, 4 months, we actually do think that the BOJ will ultimately be pushed towards changing its own interest rate stance, which would bring money back. There's a lot of Japanese money which is currently invested in the US, and some of that will go back.